Hello everybody and welcome to today's webinar. This is Pension Calculations in Sage 50 Payroll, and it's part of our Pensions Discovery webinar series for which you can earn your very own digital badge. We'll be telling you more about that badge towards the end of this session. My name's Duncan, I'm your host and presenter, and I am joined in the background by my colleague Alice, who's standing by ready and waiting to answer any questions. Let's now take a look at what we'll cover in the webinar. So we're going to start with an introduction, explaining the settings that would affect pension contributions and calculations, and reminding you where to check these key settings in Sage 50 Payroll. I'm then going to take you through some worked examples of pension calculations using different types of pension scheme with different settings. So hopefully there'll be a demo and a calculation that closely matches your specific pension scheme. And then we're going to finish the session with an opportunity for you to try a couple of calculations yourself. So we've got two calculations lined up, two challenges for you, and we will invite you to submit your answers to those calculations in the Q&A. Then we'll run through the usual further support. I'll tell you a bit more about the digital badge, and we will have that final opportunity for you to ask any of your questions. So let's get straight on to our introduction. And first of all, we'll take a look at the factors that can influence a pension calculation. So the main things that are involved in pension calculations would be your employee's pensionable earnings. Now, with some schemes, this will be specific pay elements, such as basic pay only. For other schemes, it might be qualifying earnings, which includes most earnings, but are restricted to lower and upper thresholds. The pension contribution rates would be involved in the calculation. So typically this would be a percentage, and there are minimum contributions for qualifying pension schemes. Whether your scheme deducts employee contributions before or after tax is a key setting. So this will depend on the tax relief arrangement that your scheme uses. If your scheme does use qualifying earnings for pensionable pay, this will restrict the pensionable pay between lower and upper thresholds, which are set in legislation. And if you have a salary sacrifice scheme, your employee would enter a salary sacrifice arrangement instead of making a pension contribution. The amount that they sacrifice from their salary will then be added to the employer's own contribution. So that one works a bit differently to a traditional pension scheme. So some of the key settings that I'm going to remind you of, and we covered a lot of this in our pensions basics webinar and salary sacrifice schemes, are the pension scheme settings and the pay element settings. So talking about pensionable earnings, the way that Sage 50 Payroll determines what payment is pensionable is all down to the pay element settings. So you can specify which pay elements are pensionable in the company pay elements and which are not. So a couple of examples on the slide there shows a basic payment that is fully pensionable. So the settings that we've highlighted include the qualifying earnings setting, which makes this payment pensionable for schemes that use qualifying earnings for pensionable pay. Pension main and AVC, which flags it as pensionable for schemes that do not use qualifying earnings. And we've also got that payment set up in salary sacrifice calculations for salary sacrifice pensions. And if you contrast that with the other payment on the screenshot, this payment is not pensionable. It's actually an expenses payment, so a non-taxable payment used to reimburse employee expenses. And you can see those same settings in this example are not selected at all. So that payment would not be included in any pension calculations. We'll share a couple of tips on how to check your pay element settings when we go into the demo. Now, whether employee contributions are deducted before or after tax is certainly a key factor in how the contribution is calculated and also how tax relief is given on the pension contributions. So it is a really important setting to check and to get right. Now, there are two tax relief arrangements. If your employee's pension is deducted before tax, This means that your scheme uses what's known as a net pay arrangement. And with this setting, the employee's full contribution is calculated from their pensionable pay, and that deduction is made from the employee before tax is even calculated. So, for example, if your pension scheme has a 5% contribution, the full 5% of the pensionable earnings will be calculated and deducted, and then tax will be calculated on the remainder of the pay. Other tax relief that can be used is deducting after tax, and that is known as a relief at source arrangement. Now, this is where the employee's contribution, when calculated in payroll, is reduced by the basic rate of tax, it's currently 20%, but that deduction is made after tax. And the pension provider would reclaim basic rate tax relief directly from HMRC and add that to the pension pot. Now, when it comes to the calculation for these types of pension scheme, if you have a contribution set up as 5% in the pension scheme settings, in effect, only 4% would be deducted because 20% of that 5% will be taken off, as that's the tax relief that will be reclaimed by the pension provider. So that deduction is made after calculation of tax. And the link that we've provided there at gov.uk explains those two types of tax relief arrangement. The other thing just to remind you of is the definition of qualifying earnings. So qualifying earnings would include all payments that count towards salary, wages, commission, bonuses and overtime, as well as statutory sick pay and statutory parental payments. But for schemes that use qualifying earnings for pensionable pay, the pensionable pay is restricted to earnings between lower and upper thresholds, which would depend on an employee's payment frequency. So, for example, if an employee is paid monthly, the lower threshold is £520 per month, and the upper threshold is £4,189. So it would only be the qualifying earnings between those thresholds that are used in the calculation. But it would include items such as overtime and commissions, which perhaps wouldn't be included in other types of pension scheme. And the top tip, a rule of thumb here, is that most payments that are subject to tax and national insurance also count towards qualifying earnings. But if you are unsure, or if you have a query around a specific element of pay, we would suggest you contact your pension provider and get them to clarify whether that should be included in pension contributions or not. And the other factors that we mentioned are all part of the pension scheme settings. So I've highlighted them on the screenshot here. So it includes the setting to use qualifying earnings for pensionable pay, for salary sacrifice schemes, where you can set default contribution percentages or amounts, and then the deduct before tax setting, which is found on the employee tab. So before we go into some of the calculations, I would like to just give you a few demos on what we've covered in those slides. So let's just bring the slides down now and jump into payroll. And we will start with a quick look at the pension scheme settings. So to find your pension scheme settings, you would start from your company tasks in the bottom left corner. You would then click onto pension schemes from the list of tasks. You'll see that the schemes that are set up in your software. So I've got 3 schemes set up for today's demonstrations. And to review the settings, you would select a scheme and click Edit. It'll then tell you if the scheme is assigned to at least one employee, which it is in this example, and then you'll be able to review the pension scheme settings. So the key settings I'm going to point out here are the setting to use qualifying earnings for pensionable pay. So in this particular example, the box is ticked, which means that this scheme will look at earnings that are included in qualifying earnings, but will restrict them between lower and upper thresholds. Just underneath, we have the salary sacrifice scheme setting, which in this example is not selected. So this is not a salary sacrifice scheme. If I click on the employee tab, you can see the default employee contribution has been set to 5%. in this example. And the tax relief setting for this scheme is the deduct before tax checkbox. And you can see in this example, it is not selected. So this pension scheme uses a relief at source arrangement. Pension contributions deducted after tax, and they are automatically reduced by the basic rate of tax. And then we can see here on the employer settings, we've got the default employer percentage in this example of 3%. So that is where you can find the pension scheme settings. We'll be looking at the other schemes later on in the demo. And the pay element settings are found from the same area, so company tasks. At this time, we would click pay elements. And then you can see a few different payments that I've set up here. If I edit the basic payment, you can see it's included in qualifying earnings, pension main and AVC for schemes that don't use qualifying earnings, and also in salary sacrifice calculations. And comparing that to, say, a bonus pay element, you can see this one does count to qualifying earnings. So it'll be included in schemes that use qualifying earnings for pensionable pay, but it is not flagged as pensionable for other schemes or included in salary sacrifice calculations. So some key differences that will determine how the calculation is done by your software. And a top tip, if you missed it at some of our other webinars, is that you can run a report showing all of your pay element settings in one place. So to find that, you can go to the reports icon above your employee list. You would select the company folder here on the left-hand side, and then you would scroll down and you would find the payment types report. And if I just double click to preview this report on screen, this is a really handy way of checking all of your pay element settings in one place. So we can see at a glance that my basic payment is set up as pensionable, as it has Y in the pension and AVC column, whereas all other payments are not flagged as pensionable. Got everything except expenses set up as qualifying earnings. And for salary sacrifice, we've got basic included, but other payments not included. So as long as your pension scheme settings and your pay element settings are set up correctly, you'll have correct and accurate calculations in your payroll software. So just a bit of a refresher there on some of the information we provided in our other webinars. But let's now move on to the main topic of today's webinar, and I'm going to work through 4 example pension calculations. So the way that I'm going to do this is I'm going to run through the calculation on screen on a slide, but then I'm going to show you that exact same scenario in payroll, so you can get a handle of where you would check those contributions and how any changes in the employee's pay might affect it. So we'll start off with a relatively simple pension calculation. So in this first example, we're going to look at a pension scheme where pensionable earnings are basic pay only. The employee contribution will be 6% and the employer contribution will be 8%. And the tax relief for this scheme is that it's deducted before tax, also known as a net pay arrangement. So the calculation we're going to do is based on gross pay of £4,000, which is made up of £3,500 of basic pay plus a £500 bonus. And this particular employee is paid monthly. So when I do a pension calculation, the first thing to do is to establish the pensionable pay. So in this example, we know that only basic pay is pensionable. So the pensionable pay this month is £3,500. The employee contribution is 6% of the pensionable pay. So 6% of £3,500 is £210. And because it's deducted before tax, that full percentage is what's calculated and deducted from the employee, and they would then pay tax on their remaining pay. The employer contribution is £3,500 times 8%, which in this example will be £280. And just to bring that to life, by showing you this in Payroll, let's just jump over to our Payroll software. I'll start by showing you the pension scheme settings. So the pension scheme in this example is a scheme that does not use qualifying earnings for pensionable pay. So we do not have that box selected. It's not a salary sacrifice scheme. And then looking at the employee tab, we've got the 6% contribution shown just here. And the tax relief in this example is that it's deducted before tax. The employer contribution is 8%, as shown in the pension scheme settings. And that pension scheme has been assigned to the first employee in my list. So looking at their pensions tab, if I click onto manage scheme, you can see that scheme number 3 has been assigned. And we are using the default percentage values. Now to check the pension contribution, I would return to my payroll tasks. I've already set my monthly pay date, so I'm going to go straight into enter payments. You'll see that I have £3,500 salary plus £500 bonus, so total gross pay of £4,000. But when it comes to the pension contribution, if I check the summary tab, you can see £210 is being deducted from the employee before tax, thereby reducing the taxable gross pay. And then checking the employer's area, you can see that the employer's contribution is the £280. So that is only calculated from the basic pay. So if I change the bonus amount, see there's no change to the pension contribution. But if I was to change the salary itself, you can see that the contribution then starts to increase. So that was our first example based on pensionable pay of £3,500. So let's move on to example number 2. So different pension scheme for this one. This is a pension scheme that uses qualifying earnings for pensionable pay. The employee contribution is 5% and the employer contribution is 3%. So this meets the minimum pension contributions for qualifying pension schemes. And the tax relief for this particular scheme is that the employee's contribution is deducted after tax. So this one is a relief at source arrangement. Now, because it's using qualifying earnings, it means that the pensionable pay is restricted between the lower and upper thresholds. So we've got those on the slide just for reference there. And this calculation will be based on gross pay of £2,500, all of which is basic pay. And the employee's pay frequency is monthly. So first thing I'm going to do is to establish the pensionable pay. So in this example, the employee's qualifying earnings fall between the lower and upper threshold. So to calculate the pensionable pay, we will take the total gross earnings and we will deduct the monthly lower threshold. So £2,500 minus £520, which is the lower threshold for monthly, gives us pensionable pay of £1,980. Now, the employee contribution is 5% of the pensionable pay, and 5% of 1,980 is £99. But because it's deducted after tax, we need to further reduce that by 20% or multiply by 80%. And that gives us an employee contribution of £79.20. The employer contribution is the pensionable pay, 1,980, times 3%, no tax relief for the employer, so it's £59.40. So that's how the calculation is done. Let's take a look at how it works in Payroll. So I will just bring payroll back up on screen. And for this employee, we're going to use the pension scheme that we looked at earlier in the demo. So back into my pension scheme settings, it's this one, scheme number 1, that uses qualifying earnings for pensionable pay. 5% employee contribution deducted after tax, as deduct before tax is not selected, and then the employer contribution was 3%. So that has been assigned to employee 2 in my list. And if we have a look in the enter payment screen, you can see £2,500 of salary. And looking at the summary, here is our pension contribution of £79.20. Now this time, the taxable gross pay has not been reduced because this deduction is being made after tax, but this amount has been automatically reduced by 20%. The employer's contribution is your £59.40, as can be seen here from the employer button. And because this is a scheme that uses qualifying earnings, if we were to add any additional payments, such as a bonus that counts towards qualifying earnings, you'll see that the pension contribution also increases in line with that pay increase. So this time it is looking at all payments flagged as qualifying earnings, which in this case would include bonus payments, but would not include the expenses payment that we have set up to be not pensionable at all. So yeah, this is a scheme using qualifying earnings for pensionable pay. So I will move on to the next example. So we're actually going to use the same pension scheme for this example. So it's a scheme using qualifying earnings. The employee is contributing 5% and the employer is putting in 3%. It's deducted after tax, so a relief at source arrangement. But this time we're dealing with a weekly paid employee, and their total gross pay this period is £1,040, which is made up of £540 of basic plus £500 commission. So for this employee, when we look at the lower and upper thresholds for a weekly paid employee, we can see that they are earning above the upper threshold. So their pensionable pay in this example is simply the upper threshold minus the lower threshold, which for weekly paid employees is 967 minus 120, giving us pensionable pay of £847. Employees' contribution is the 847 times 5%, which is £42.35. But because it's deducted after tax, we're going to reduce that by 20% or multiply by 80%, giving us an employee contribution of £33.88. Employer's contribution is the pensionable pay, 847 times 3%, which for this employee will be £25.41. So let's have a look at this one in payroll, and we'll make some changes to the pay just to see how that affects the pension contribution. So I will just select one of my weekly paid employees and set my weekly pay date, which will be this Friday. I go into the enter payment screen. You can see we have basic pay of £540 plus commission of £500, given a total gross pay figure of £1,040. And when I select the summary tab, you can see the employee pension contribution is £33.88. And the employer's contribution is your £25.41. Now, in effect, that is the maximum pension contribution per week for this scheme because the employee's earnings are above the upper limit. So even if that commission was double, so they got £1,000 of commission in that week, I've had a really good week, you can see that the pension contribution has not changed at all because effectively it's at its max. Let's say, however, the commission was lower than what we had originally, so maybe it was only £250, bringing the employee's total gross pay below the upper threshold, so it's £790 now. This is the point at which we see a change to the pension contribution, so those contributions have now reduced accordingly. So that is an employee with a scheme using qualifying earnings where they're earning above the upper threshold. And I have one final example to show you. So we're going to include a salary sacrifice calculation. This is example number 4. So for this pension scheme, the pensionable earnings will be basic pay only. The employee has a salary sacrifice of 5% of their basic pay. The employer contribution will be 3%, and officially there's no tax relief. Instead, we're using a salary sacrifice arrangement. Now for this calculation, the gross pay this period is £2,750, all of which is basic pay, and the pay frequency is monthly. So just like before, first thing we'll do is establish the pensionable pay, which is the £2,750, all of the basic pay. Then we can calculate the employee salary sacrifice amount, which is the basic pay, £2,750 times 5%. So the employee has a salary sacrifice of £137.50. Now that isn't technically the pension contribution. The employee doesn't make a direct contribution to their pension. What happens instead is that the employer contribution, which was 3% of the pensionable pay, given us £82.50, is then added to the salary sacrifice, the £137.50, giving us a total employer contribution of £220. And because that's just an employer contribution, there's no tax due on that payment. The salary sacrifice is deducted before calculation of tax and national insurance. And this one looks slightly different on a pay slip. So I've got an example of a pay slip on the slide here. You can see the salary amount, £2,750. The salary sacrifice is a negative payment line. And then the employer pension is the only pension contribution shown, and that is the full £220, which actually equates to 8% of the salary. So the 5% salary sacrifice plus the 3% employer contribution. Now, there is also a setting for salary sacrifice schemes to include the employer NI saving in the employer contribution. So if you had that activated, if you had that box ticked, the way that the employer NI saving is calculated is you take the salary sacrifice amount, the £137.50, and you multiply by the employer's NI percentage, which is 15%. That gives us £20.63, which means that with that setting selected, that would also be included, given a total employer contribution of £240.63. And just to show you that one, let's just jump into payroll one last time. Just going to set my monthly pay date again. And I'll first show you the pension scheme setting. So it's a salary sacrifice scheme that we're using in this example. You can see we are not using qualifying earnings for pensionable pay. We have flagged it as a salary sacrifice scheme. We've opted not to add the employer NI savings. The employee sacrifice is 5% of their basic. And the employer contribution is 3%. So that's the pension scheme setting. This is the employee with the scheme assigned, employee number 3. So if I go into the enter payment screen, we've got the £2,750 salary. But checking the summary tab, there is no employee pension contribution. And instead, you'll see a salary sacrifice of £137.50, reducing the employee's gross pay for tax and national insurance to 2612.50. So here on the summary tab, we can see that reflected in the taxable gross and total gross pay. And if we check the employer's contribution, that's a total of £220. So it's a 3% they're putting in themselves, plus the salary sacrifice amount. And just to compare those three scheme settings on payslips, if I go into my pre-update reports, just run one of our standard payslip layouts. So first employee was where basic pay was pensionable and it was deducted before tax. So we can see both pension contributions in with the deductions. And you can see here on the right-hand side, the gross for tax has been reduced. However, earnings for national insurance have not. Looking at the next employee, this was a deduction after tax. So we're still seeing pension contribution amounts, but the gross for tax is the same as the total gross pay. So they're paying tax on all of their salary in this example. Tax relief is being claimed back by the pension provider. And then the third example was the salary sacrifice with that negative pay line. So they just have an employer contribution, employer only, and their earnings for NI and tax have been reduced by the salary sacrifice amount. So hopefully in and amongst those demos, we have featured a scheme that works similar to how your scheme works as well. So we're going to finish off with a bit of a pension challenge for you guys, a couple of calculations to try yourself. So the way that this will work is we'll give you a couple of minutes on each of the calculations, and we would invite you to use the Q&A to submit your answers to the following calculations. So let me talk you through the first one. So your first calculation is for a pension scheme where basic pay is pensionable earnings. The employee's contribution is 5%. The employer's contribution is 7%. And the tax relief arrangement is it's deducted before tax. So this is a net pay arrangement. So the gross pay that you're calculating this on is a total of £3,000, made up of £2,500 basic plus £500 commission. The pay frequency is monthly. So your challenge, and you can share this in the Q&A, is to work out the pensionable pay in this calculation, and then work out the employee contribution and the employer contribution. And I'm going to give you a couple of minutes to submit some answers before we go through that example together. So that is your first pension challenge. Okay, I can see some good answers coming through already on that one. Just in the interests of time, I will start to work through the solution. So the way that you would work this one out is by first establishing the pensionable pay, which in this case was basic pay only. So this month it was £2,500. The employee's contribution was 5% of £2,500, which of course is £125. And as it's deducted before tax, that full percentage is deducted and tax is calculated on the remainder of the pay. Employer contribution, 7% of the pensionable pay, so 7% of £2,500 is £175. And from the answers I've seen in the Q&A, it looks like everyone has got that one correct. So well done to those of you that solved your first pension challenge. Let's have a look at the second one, a little bit more involved in this calculation. So for the second one, we're using a pension scheme where pensionable earnings are qualifying earnings. So we've ticked the box to use qualifying earnings for pensionable pay. The employee contribution is 5%, the employer contribution is 3%, and the tax relief for the employee is that it's deducted after tax. So it's a relief at source arrangement. The employee's total gross pay this period is £640, made up of £540 basic plus £100 commission, and their pay frequency is weekly. So same deal as before. Start by working out the pensionable pay, and we've popped the lower and upper thresholds on the slide to help you out there. Then go on to work out the employee contribution and then the employer contribution. So let's give you a couple of minutes on that one. When you've got the answer, if you can pop that in the Q&A. Okay, so again, some great answers coming through already on that one. So well done for those of you that have had a go, and for those of you that have got the correct answer. I'm going to work through the answer now, again, just in the interests of time. So the way that we work this one out is by first establishing the pensionable pay. So the total qualifying earnings was £640. That's between the lower and upper threshold for weekly. So we deduct the lower threshold of 120, giving us pensionable pay of £520. Employees' contribution is 5% of that pensionable pay, which is £26. However, due to the tax relief arrangement and it being deducted after tax, we multiply that by 80% to reduce by 20% tax relief, give an employee contribution of £20.80. I think pretty much all of you got. And then the employer contribution was the pensionable pay, £520 multiplied by 3%, and that comes to £15.60. So big well done to those of you that got 2 out of 2 in those calculations, or for even having a go at it. Looks like most of you have got the hang of that, so very well done. And we are actually nearly out of time. So what we will do is I'll run through the further support as promised and more details on the digital badge. If you have any final questions that you'd like to ask the team, pop them in the Q&A now. We'll look to get some answers out to you. So this is one of the sessions that counts towards our Pensions Discovery digital badge. If you are able to join us on at least 5 different webinars live, plus one of our pensions quiz sessions, you will qualify for the digital badge, which we'll be sending out to you by the end of July. So we still have some sessions available. So you still have a chance to get 5 of the main sessions plus one of the quiz sessions. And you can sign up for any of the available sessions on our website, sage.co.uk/webinars. If you're looking for further support with your payroll software, look no further than our help centre at sage.co.uk/help, or by selecting any help icon in your payroll software. From there, you can search our knowledge base and read support guides, get a link to the upcoming webinars, and also the link to get in touch should you need to contact our support team. I also want to mention our personalised training service. You can get one-to-one remote training delivered by a Sage expert and tailored to your exact requirements. So you're getting clear solutions that you can apply immediately to your needs. This will give you greater confidence and accuracy, and the sessions are delivered remotely, conveniently from the comfort of your own desk. So if you would like to discuss your options for personalised trainings, please do complete the inquiry form by scanning the QR code. We will also include a link to that form in your follow-up email. So can't recommend that service enough. And that is the end of the content of today's webinar. We will stick around a few more minutes just to give you that opportunity to send through any final questions or comments. If you'd like a copy of the handout, which has all of those worked examples, do remember to download that before you leave us today. You can do so by clicking on that piece of paper icon. We've got the printer-friendly version. We've also got the full colour version as well. We will send you a follow-up email, which includes a link to the recording of today's webinar. So look out for that in your inbox later today. And one last ask from us: when you leave the webinar today, we'll invite you to take a survey. It would be great to know what you thought of today's sessions and any suggestions you might have for future webinars. We read all of your comments, and we do use that to ensure that our webinars are the best they can be. So please consider taking a moment to complete that survey. So I am going to go briefly onto mute just to check on the questions situation, and we'll be wrapping up in a couple of minutes. So I will speak to you shortly. Hi again, everyone. Thank you so much for your participation today. We haven't had any questions come through the last few minutes, so we are going to wrap the session up. If you wouldn't mind taking a minute just to complete that survey as you leave, we'd very much appreciate hearing your thoughts on today's session, and do look out for the follow-up email arriving later today. But on behalf of myself and Alice, thanks so much for joining us today, and we look forward to seeing you on some of our other webinars in the near future. But it's goodbye for now.